Hi. Today we are going to discuss an exam-oriented class for the plus 2 students. We know that the plus 2 examination is coming the nearest months. These portions will be very helpful for the students. The chapter name is Admission of a Partner. Admission of a Partner. Admission of a partner is one of the reconstitution of a firm. Reconstitution of a firm. Why admission of a partner is called a reconstitution of the firm? Because existing agreement comes to an end and a new agreement comes into existence. Through the admission of a partner, a new person admitted into the partnership business with the consent of all other partners. That is known as admission of a partner. In simply we can say inclusion of a person into a partnership business is known as admission of a partner. That partner is called an incoming partner. When a new partner enter into a partnership business, that partner has two rights in that particular business. First one, a right to share the future profit or loss of the business. Number two, right to share the assets or liabilities of the business that may be arised in the future. When a new partner is admitted into the business, we know that existing partners have to sacrifice some profit in the future. That means we have to give some portion of the profit to the new partner also. To cover this sacrifice, the new partner brings or pays some amount to the existing partners of the firm, that is known as premium for goodwill, or we can call as goodwill. This is the brief introduction about this chapter. Admission of a partner is one of the modes of reconstitution of the firm, because the admission of a partner, existing agreement comes to an end and a new agreement comes into existence. Inclusion of a new person in the partnership business is known as admission of a partner. After the admission of a partner, the new partner gets two rights from the business. First one, right to share the future profit of the firm. Number two, right to share the assets of the firm. New or incoming partner receives a share in the future profit. That is equal to the sacrifice made by the existing partners. Sacrifice made by the existing partners of the firm. The amount of the new partner pays for their sacrifice is called premium or goodwill. In simply we can say, whenever a new partner is admitted into the business, the existing partners have to sacrifice some profit in the future. To cover that one, the new partner brings or pays some amount. That amount is known as goodwill or premium for goodwill. When admission of a partner happens, what are the adjustments required in a partnership business? A new person is entering into a partnership business. That partner has two rights is there. We know that one. Then whenever a new partner is admitted into the business, a number of accounting adjustments we have to do in the partnership business. Number one, change in the profit sharing ratio, because new partner is coming to the business. Therefore, new ratio should be calculated. And we know that we have to calculate the sacrificing ratio of the partners also. Why? Because whenever the new partner is admitted into the business, the existing partners have to sacrifice some profit in the future. So we have to calculate the sacrificing ratio. Sacrificing ratio is equal to old ratio minus new ratio. We will get the sacrificing. Number two, valuation and adjustment of goodwill. We know that the business is running on and they have their own reputation, their own customers, they have enough profit. Therefore, we have to find out the value of the goodwill Number 3, revaluation of assets and readjustment or reassessment of liabilities. We have to revalue all the assets and we have to check or reassessment all the liabilities of the business also. Adjustment for reserve or accumulated profit and losses. Accumulated profit means the profit of the coming previous years are put in an account. That account is known as accumulated profit account, or we can call as reserve or P&L account. This also we have to do the adjustments. Then adjustment of capital. Sometimes we have to readjust the capital on the basis of the new partner's profit sharing ratio. If the partners so agreed, we have to readjust our capital based on the new profit sharing ratio. These are the accounting adjustments required when the admission of a partnership happens. Next adjustment is accounting treatment for the goodwill in admission of a partner. First point, they are saying goodwill paid privately. Sometimes the new partner pays goodwill privately to the partners. We can say it is outside the business. They are settling that deal outside the business. Therefore, no journal entry is required, no record in the books of account is required. That is the first adjustment for the goodwill. Sometimes the incoming partner pays goodwill privately to the old partners. No entry is required because this transaction is outside the business. Number 2, goodwill brought in cash by the incoming partner and it is retained in the business. We earlier discussed that one. For the sacrifice made by the old partners in future profit, the new partner pays some amount as goodwill. That is known as goodwill or premium for goodwill. Here the new partner brings his share of goodwill in cash and that is retained in the business. Cash account debted to old partner's capital account. That cash we put in the old partner's capital account. That means the amount is in the partner's capital account. That means retained in the business. They are not withdrawn. First entry. Instead of this one entry, we can pass 2 entry also. Firstly, they bring goodwill. Cash account debted to premium for goodwill. Premium for goodwill account debted to old partner's capital account. That is known as sacrificing partner's capital. Instead of writing these 2 journal entry, we have to pass only 1 entry is there. Net entry is required because this premium for goodwill and this premium for goodwill will be nullified. One debit and one credit will nullify, and the net entry is cash account debted to sacrificing partner's capital account or old partner's capital account. The ratio here is used as sacrificing ratio. Why we are using here sacrificing ratio? It is the sacrifice made by the old partners in the future profit. That is why this amount is divided in the sacrificing ratio. Third, goodwill brought in cash and withdrawn by the sacrificing partners fully or partially. If they need, they can fully withdraw. No, they are 50% only they are withdrawn. That also possible. Fully or partially. When goodwill is bringing cash account debted to sacrificing partner's capital, or we can call as old partner's capital account. And this amount is fully or halfly withdrawn. That is sacrificing partner's capital account debted to cash. 3 adjustments. Number 1, goodwill paid privately. Number 2, goodwill brought in cash and retained the business. Number 3, goodwill brought in cash and fully or partially withdrawn by the old partners. Adjustment of goodwill. 4th point. Sometimes the new partner brings his share of goodwill in kind. The journal entry is kind means any asset. The journal entry is asset account debted to sacrificing partner's capital account. The ratio is sacrificing ratio because it is the compensation of the sacrifice. Sometimes the new partner unable to bring goodwill in cash. Instead of cash, he is bringing some assets or kind, we can say. Goodwill brought in kind. The journal entry is asset account debted to sacrificing partner's capital account. Goodwill adjustment number 5. When goodwill is not brought in full or part in cash by a new partner. Sometimes the goodwill is, the new partner cannot bring his share of goodwill in cash or in kind. He is unable to contribute that amount. In such a situation, firstly, you have to check in the balance sheet any goodwill already existed. In the balance sheet question, maybe in the balance sheet asset side, goodwill is there. Firstly, you have to write off the goodwill. The existing goodwill in the balance sheet, we have to write off first. The journal entry is old partner's capital account debtor to goodwill. This is the entry for writing off old goodwill in the balance sheet. The ratio is old ratio. Sometimes I told you the new partner is unable to bring his share of goodwill in cash or kind. At that time, we have to pass one journal entry, new partner's capital account debtor to sacrificing partner's capital account. New partner's capital account. Why here new partner's capital account is debited? Because the new partner amount should be adjusted from their capital later. That is why we give a debit. He should pay later. New partner's capital account debtor to sacrificing partner's capital. That means in the future we will cover this amount from his capital account after the joining of the business. Sometimes in the question goodwill amount is not given, we can call as hidden goodwill. Hidden goodwill means goodwill amount is not exactly given in the question. Hidden goodwill in this case, firstly we have to calculate the total capital of the firm. We have to calculate the total capital of the firm on the basis of the new partner's profit share and his contribution as capital. That means based on the new capital and based on the new partner's share, we are finding the total capital of the firm. Example, the new partner brings 10,000 as capital for 1/5 share in the future. So for 1/5 share, he is contributing 10,000 as his capital. Therefore, the total capital is 50,000. 50,000, 10,000 multiplied by 5 divided by 1. So the total capital of the firm on the basis of the new partner's share and capital, the total capital is 50,000. This capital is divided by all the partners. It is known as hidden goodwill. Therefore, the remaining amount, if some extra amount, now you go to the total capital of the firm. From the total capital, you can minus existing partner's capital and the new partner's capital. Some amount is remaining there, that is known as goodwill. So, goodwill brought in kind, asset account debtor to sacrificing partner's capital account, ratio sacrificing ratio. When goodwill is not brought in full, if goodwill is already existed in the balance sheet, you have to write off first. Second, new partner is debited and sacrificing partner is credited. Hidden goodwill, in this case, total capital of the new firm is calculated on the basis of the new partner's share and the capital. So the total capital minus all partners new as per we calculated minus it, that is known as goodwill. Admission of a partner. Third important adjustment is revaluation of assets and reassessment of liabilities. When a partner is admitted in the business, at that point of time, all the assets and the liabilities should be revalued. The profit or loss on the revaluation transferred to old partner's capital account in old ratio. Because new partner is entering the business, same point of time, we want to know how much is the increase and decrease in assets and liabilities. From these, any benefit or loss occurred, it should be suffered by the old partners in their old ratio. So, admission of a partner, we have to prepare revaluation of assets and reassessment of liabilities. Revaluation account is prepared to bring down all the assets and liabilities in true value when a new partner is admitted in the business. The profit or loss on revaluation should be transferred to old partner's capital account in old ratio. So revaluation account is just like a T-shaped account. Debit side and credit side you can see. A plus L minus. A plus L minus in the credit side. A plus means asset is increasing. L minus means asset is decreasing. A minus, asset decrease, liability increase. So what are the journal entries affecting the revaluation of assets and liabilities? When asset increase, asset account debtor to revaluation. Asset decrease, revaluation account debtor to asset. When liability increase, revaluation account debtor to liability. When liability decrease, liability account debtor to revaluation. Unrecorded assets, asset account debtor to revaluation. Unrecorded liability, revaluation account debtor to liability. These are the main journal entries affecting the revaluation account. Asset increasing, always debit only. Debit assets. Asset account debtor to revaluation. If it is asset is decreasing, opposite entry. Liability, we know that always credit balance only. If liability is increasing, liability credit and revaluation debit. If liability is decreasing, opposite, we can record that one. So instead of memorizing the journal entries, you can do a test also. This side, whenever you are preparing the revaluation account, the credit side only asset increase and liability decrease only will come. The debit side of the revaluation account, asset decreasing and liability increasing is affecting. So the revaluation profit or loss, if the credit side is more, that means revaluation profit. If debit side is more, that means revaluation loss. Profit or loss, it should be suffered by the old partners in their old ratio. So revaluation account is one of the important account in the admission of a partner. Now you know how to prepare the revaluation account and what are the journal entries affecting the revaluation account. Asset increasing, asset decreasing. Liability increasing, liability decreasing. Unrecorded as unrecorded liability. Sometimes we have to prepare a memorandum revaluation account. Memorandum revaluation account preparation is required whenever the partners are decided not to change the value of assets and liabilities. That means they are decided to retain all the assets and liabilities value as old value. In such circumstances, you have to prepare one more account. That account is known as memorandum revaluation account. Old value exists, the old value. Whenever you are preparing the memorandum revaluation account, firstly, you have to prepare the revaluation account as usual. And the balance is divided into old partners in old ratio. We know that one. Second, of same ledger account, you can prepare reversal entries. Debit given, you can give credit here in the memorandum revaluation account. Whatever credit in the revaluation account you are given, you can debit here. That means all the entries are reversed and their balance, and that means memorandum revaluation account balance is transferred to all partners capital account in new ratio. So, firstly prepare the revaluation account. Secondly, if the question says the value of assets and liabilities are not changing, they agreed like we have to prepare a memorandum revaluation account also. The memorandum revaluation account, there is two steps are there. Firstly, you have to prepare as usual revaluation account. It is shared by the old partners in their old ratio. And the second is memorandum revaluation account. Whatever amount you debited in the revaluation account is credited, and the credited amount will be reversed into debited in the memorandum revaluation account. And the balance of the revaluation account is divided by all the partners in the new ratio. Next, adjustment number 4. Treatment for reserve and accumulated profits or loss. Accumulated profit or loss means the profit earned by the old partners in the previous years. We know that every year they are making some profit. It will be accumulated in an account. That is why it is known as accumulated profit. This accumulated profit and loss is the benefit is given, or it is divided to whom? Old partners only, because it is their money. So we will distribute the accumulated profit to old partners capital account in old ratio. Profit and loss account, general reserve, workmen's compensation reserve, investment fluctuation reserve. These are the main reserves, accumulated reserves. These should be divided into the partners capital account in old ratio. Sometimes there is accumulated loss also happens there. Accumulated loss means loss of the previous years. It should be suffered by the old partners. Therefore, old partners capital account debted to P&L. This is the loss debit balance. Profit and loss account credit balance means profit. Profit and loss account debit balance means loss. So this is divided into old partner's capital account. Then deferred revenue expenditure, if any. Deferred revenue expenditure means the benefit will be not only 1 year in subsequent years. Therefore, we will write off partially only. So the best example of this one is advertisement suspense account given in the balance sheet. That also you can write off in the old partner's capital account. Accumulated profits and accumulated loss. Accumulated profit is divided to old partners in old ratio. Accumulated loss also same way. One of the important point is sometimes balance sheet at asset side you can see advertisement suspense account is there. This also will be divided to the old partners. This is a loss for the old partners in their old ratio. From the accumulated profit and losses, whenever you are dividing accumulated profit and losses, you can see two important items. One is workmen compensation reserve and the second one investment fluctuation reserve. This workmen compensation reserve means we are creating a reserve from the profit. This amount is created out of the profit of the company. If some workmen's claim is coming to distribute that one, because sometimes workmen compensation, some problem is happened, some injury or something claim is we have to given, that for utilization of that one, we are set aside some amount from our profit. That amount is known as workmen compensation reserve, WCR. There is no claim. We already made a provision for WCR. No claim is there. The full amount of the WCR divided to old partners capital account in their old ratio. If there is no claim, no need the provision. Full amount you can given to the old partners. Claim exists. There is some claim. Partial amount is there. For example, 50,000 is the workmen's compensation reserve. 30,000 is the claim. 20,000 you can divide it to the partners. The entry is workmen's compensation reserve account debtor. Provision how much you want to keep, you can put it that one. Old partners capital account, remaining amount the partners can credit in their account. Example, workmen compensation fund 50,000. Liability arise to 20 only. Therefore, extra 30,000 is there. That you can divide it into old partners capital account. Sometimes claim is equal only. Whatever amount claim you made and the provision also same. Therefore, workmen's compensation reserve account debtor to provision for WCR. Sometimes the provision is less. You required more amount. The claim came more amount. At that time, the extra amount you can take from the revaluation account. So WCR account debit, revaluation account debit to provision for WCR. So these are the important points to be noted while dividing WCR. No claim, what is the entry? There is a claim, what is the entry? There is an equal amount, what is the entry? More than claim came, what is the entry? 4 journal entries are there. So based on the question, you have to do the answer. Same model, one more reserve is there, investment fluctuation reserve. Why we are keeping the investment fluctuation reserve? Because investment value will be increase or decrease. To adjust that one, you already made a provision. That is known as investment fluctuation reserve. So investment fluctuation is book value and market value is equal. First point, book value of the investment and market value of the investment is equal. The amount is what? There is no change. That means full amount you can transfer to old partners capital account. Market value is less. The remaining amount, the investment remaining amount you can divide the partners capital account. It is equal. The full amount you can transfer to the investment account. More than is coming, the extra amount you have to take from the revaluation account. Same, the above, both the cases are same. And the last adjustment of the admission of the partner is readjustment of capital. If the partners agreed, we have to readjust the capital of all the partners. How we can do the readjustment of capital? Firstly, we have to find out the total capital of the firm based on the new profit sharing ratio or the share of the new partner and his capital. 10,000 is the new partner capital. His share is 1/5. So the total capital is 50,000. The total capital can be divided in the new ratio. If any shortage is coming, this will be brought by the partner. If some partner have excess in our books of account, they can withdraw the amount. That can be possible through the cash account or the current account, it can be possible. So we have to readjust the capital account of the partner on the basis of the share brought by the new partner as his capital. So we have to find out the total capital of the firm and this capital is divided in the new ratio. Whenever you are dividing the new ratio, some partner has excess capital and some partner has deficit capital. This capital can be distributed to the partners, and shortage, if any is there, they can bring the cash. This can be done through cash and current account. This is the chapter summary of the partnership, admission of a partner. What are the important points to be noted? The calculation of the sacrificing ratio and a new ratio, goodwill adjustment, revaluation of assets and liabilities, then a readjustment of capital, accumulated profit and loss treatment. So go through the points, whatever we discussed, and we will upload the important notes, important key points along with this video for your reference. Thank you.